So you were talking to a prospective seller yesterday. She had a question. What question did she have?
She asked about the appraisal on her house. We're concerned about the appraisal on a house that we're going to list. And she had the same, well, not everybody, but a lot of people have the same misconception, or they just don't know that, you know, they believe that a property only needs to appraise for the mortgage amount. Like, for example, if you're buying a $300,000 house and you're putting 20% down, the mortgage is $240,000. They assume that the mortgage the appraisal only has to come in at $240,000, and that's of course not true. The property, regardless of how much you're putting down, the property has to appraise for the purchase price, $300,000. It's not about the way to look at it isn't to look at the amount of money they're putting down. It's to look at the loan-to-value ratio. 20% down, $300,000 is a loan-to-value of 80/20. So the mortgage gets all the mortgage documents, the application that gets turned in for underwriting approval and for final approval and for closing, it gets put in at an 80% loan-to-value, 80% of 300. So if the property only appraised for 290, well then the mortgage is only applied for 80% of 290. And that's where people kind of mess up. They think that it's only got to appraise for the purchase price, and it's got to appraise for the entire, it's got to appraise for the entire purchase price, not just the loan amount.
What about if the buyer's asking for closing costs? Same thing.
Yeah, if there's closing costs involved, nothing really, that doesn't affect it at all. The purchase, the first page purchase price is what it must appraise for. If someone's asking for closing costs, which of course is kind of common, on a $300,000 deal they might ask for $10,000 in closing costs. Well, that really just means the seller's really not getting $300,000, the seller's getting $290,000, because $10,000 of it is going back to the buyer to offset their closing costs. But regardless, the front page purchase price is $300,000. It's got to appraise for $300,000. Now, in situations where there's closing costs being asked for by the buyer and the seller has agreed to do that, that's always the first thing that goes away when a property doesn't appraise. If a property doesn't hit the appraisal mark, the full purchase price, then the first thing that the seller is going to do is say, okay, well, I'm not giving you your credit. You know, I want most of the proceeds from the sale to come to me, because, you know, I agreed to give you $10,000 if it appraised for $300,000. But if it didn't appraise for $300,000, I'm not giving you $10,000. And the problem with that is most buyers, when they ask for closing costs, they actually need those closing costs to close. So at the end of the day, when a house does not appraise for the purchase price, more than likely the deal dies. And so that was just she had that misconception, or they weren't sure if it had to appraise for purchase or for loan amount. And it's always purchase price, and it's always based on the loan to value. 80/20, 70/30. I mean, we just had a deal die not too long ago that was, you know, a $450,000 purchase, and it died with a $100,000 mortgage. The guys were putting $350,000 down, and it's dead because of some, you know, financial problems. So the loan to value ratio is the thing to look at, not the appraisal amount and the purchase price.
Okay. Anything else you want to say?